Hello, this is Rain Woof. Welcome to a special edition of Wind Down Wednesday. Today I have Joe as our guest. He's going to be talking about the state of the market. Now, Joe, I know you're not a wine person,
That's
but
right.
I heard you had another recommendation for us for like a nice, refreshing summer drink.
Absolutely. So this summer, I've been really excited about what Devil's Backbone has come out with. Some of their smashes. They have a ton of different flavors. It's more of a canned cocktail, if you will. But I think there's flavors out there for everybody, and they're definitely good for sipping while you're out on your boat, out on the beach side. Definitely recommend those.
Great. And you can get it at most local grocery stores
That's right.
here.
Just about every grocery store I've seen it at.
Okay, great. Well, we'll have to check out these Devilbacks mixed drinks. So, with that being said, I wanted to give you some time to talk about the state of the market. So I'm going to let you kind of kick it off from there.
Sure. So, just to start off, we are seeing many fewer homes sold, especially compared to this time last year, but also just compared to earlier this summer. And so, this is a normal slowdown that we expect to see during the summer months. A lot of people try to be in that new home so that their kid isn't that new one in class, middle of December, middle of the springtime. So there's a lot fewer people out looking for homes. And by the same token, when people are speaking to their realtor about the best time to list, they're often telling them, let's try to hit the spring market or maybe wait until the fall when there's more people looking, just because there's so many people either on vacation or out of the market to purchase.
Yeah, definitely seeing a slowdown, especially right now. Be interested in hearing about other thoughts in terms of what's causing the slowdown and how this summer might have been a little bit different than last summer.
Yeah, the summer is a little bit different. You're right. We saw that massive increase in interest rates from where we were coming out of last year. A lot of people still getting in the high 2% interest rates. And right now we're seeing average interest rates hovering right around 5%, really just kind of depending on what kind of products you're looking at, especially people with higher credit scores, higher down payments can certainly see something in the fours, even 4.5%. But I think most of our buyers, especially first-time home buyers who might be looking at a condo, will see upper 5% and even into the 6%.
Yeah, I know you're going to talk about later in terms of how higher mortgage rates really impacts a buyer's purchasing power.
Right.
And I know you prepared some slides in terms of, I noticed that there's been some decreases in number of homes sold, even though the inventory has been still relatively low. So still a seller's market, but a little bit more balanced for a lot of buyers.
That's right. Anecdotally, I've been seeing a lot more contracts keeping multiple contingencies where we would never have seen that last year in a competitive market. I've seen seller concessions, and I think that's really a good, healthy state for the market to be in.
Yeah, that's good to know. Did you want us to walk through some of the market data that you have prepared for us today?
Absolutely. I think let's turn it over to some of the more specific cities within the Northern Virginia region. Really, Fairfax County in general, huge gains we've seen in average and median purchase prices, really reflecting that there's still a strong demand for homes. And one of the common denominators across all of these regions represented is it's a high density of single family homes, very low multifamily dwellings. And I think I shared this with you a couple weeks ago. We have a critical undersupply of single family housing, especially as we've seen a demographic shift in preferences, kind of starting with COVID, and really seems to be cemented now that people are looking for a little bit more space. But we've got a critical undersupply of new homes for them to move into. So we're seeing fewer home sales, people are staying in place, but much higher purchase prices.
Yeah, that's right. If you remember from our last day of the market, we talked about how there was a trend towards people moving from closer to the city to further out in the suburbs to get more space. And I totally agree with you. And I think there's definitely a challenge with having enough supply for single family homes. I know there's a lot of talk about rezoning and creating more duplexes, triplexes, so there's more density, so we can have more supply of homes, especially for kind of that, what they call the missing middle.
Right.
So that's definitely, I think, a challenge here. But I think the flip side is that it's been really good for home price appreciation because of the lack of supply.
That's right.
In inventory.
Yeah, a lot of people have built a lot of generational wealth through real estate. And I think for a lot of people out there who are looking to find out more about how they can get involved in creating some of more of that more affordable housing or higher density housing, check out the YIMBY movement, pretty much the exact opposite of the not in my backyard movement, really trying to figure out how we can create more affordable housing and a little bit more dense housing as opposed to single family homes everywhere throughout the DC region.
Yeah, and Joe, you were talking about generational wealth. Can you talk a little bit more about that? Are you seeing a lot of, and I've experienced it myself as well, in terms of a lot of parents helping their kids purchase a place, but also I'm starting to see a lot of multi-generational families that are actually living together.
Right. Yeah, we've been seeing a lot of cohabitation across generations, but what's really surprised me is just how the older generations continue to have that extra cash laying around that they don't necessarily need for their retirement right now, and they're passing it on usually in the form of gifts for real estate transactions. And so that is also what's been supporting some of the higher purchase prices we've been seeing with people who have been concerned about the monthly payment. But if you can get that gift of cash from a relative, we're going to talk a little bit more about how it affects the monthly payment later, but it really drops that monthly payment number to make it significantly more affordable. And as long as we have elder relatives or parents willing to give that kind of gift of cash, I don't see a slowdown in this particular market when we have so much of that floating around.
Yeah, I was going to say, I think a lot, especially with first-time home buyers, if they don't have the help of their parents, I've seen a lot of people that are getting engaged and married, and instead of, they're getting, they have a smaller wedding, and they end up getting like a larger wedding gift to help them put a down payment on a place. So I think they're very fortunate because in today's market, especially in Northern Virginia, affordability is definitely a challenge for a lot of people.
Certainly. I think if we move over to the next slide, it dovetails really nicely into this. This is something I pulled together showing home ownership rates by age. So it's all been normalized by age when somebody purchases their home. And we can see that millennials, the generation that is buying some of the most homes in this area right now, I've seen statistics somewhere between 30 and 45% of all the buyers we're seeing in Northern Virginia right now are those millennials. They're still lagging behind the other previous generations on home ownership rate. And so, long term, this is going to have a huge effect on wealth accumulation for that demographic group.
Yeah, and I think a lot of millennials are probably challenged with student loans that are trying to pay off as they're getting out of school. So that probably explains some of their challenges into getting into home ownership.
Absolutely. And we're seeing that it's probably going to hit a lot harder coming up in a few weeks here when the student loan forbearance ends right at the beginning of September. People's liabilities are going to shift massively. The credit bureaus have been reporting $0 payments for the last 2 years during COVID since we've been on forbearance. And those numbers are going to start really affecting purchasing power for people who have student loans right now.
Yeah, I was going to add to that as well. I think the other thing that we're seeing is also credit card debt. For a lot of people that are existing homeowners, I definitely recommend to talk to someone like Joe about getting a HELOC to get a home equity line of credit that you can have available to use, maybe to help pay for your kids' college or to do some home improvement on your existing home. And I think for a lot of first-time home buyers, it is an expensive market in Northern Virginia, but I think it definitely pays to kind of get in early. And a lot of people are doing what they call house hacking, where they would buy a place, even if it's a condo, you can rent out a room, because a lot of millennials that I've met, they're already having roommates already.
Right.
So if they're able to buy into a place, even to start out with a condo and rent out to someone as a roommate, it definitely gets them kind of early in the game of home ownership so they can upgrade later.
Absolutely. I bought into that completely when I bought several years ago for my first home. That's exactly how I was able to afford, because even then, home ownership for a person, working for the federal government on a fairly low salary, it was very difficult to afford by yourself. And so having that house hacking method where you can maybe have a 2 or 3 bedroom home and rent out additional rooms definitely brings the affordability within reach.
Yeah, that's good to hear. And I guess not to get too personal, but I think you've kind of taken it from there and you've kind of upgraded and you've purchased some investment properties as well, right, Joe?
That's right. So we kind of pursued the additional part of house hacking, which is buying as personal properties and then living there for several years, and then rolling into a new personal property, moving there, living there for a few years. And you can continuously buy properties that way, so long as you maintain really good debt to income ratios, good credit scores, and then continue to save up for additional down payments. Buying as a primary residence is my favorite way for people to build wealth, because it requires less of their own cash, more of the bank's cash to purchase, and interest rates are significantly lower.
Yeah, and I think if you purchased a while ago, you probably benefited from a lot of appreciation in your first purchase.
That's certainly right. And you can use a lot of that appreciation to help fund your next transaction. Like you were talking about, people take out home equity lines of credit or cash out refinances. And the biggest thing to think about is making sure that the cash flow numbers still work. And so that's definitely something to talk to your realtor about, to make sure that the market comps when you're going to start renting it out fit exactly what you're contemplating that new mortgage amount to be.
Yeah, and I think maybe on another episode, or if, for those of you that are listening, if you're interested, you should definitely talk to Joe, maybe talk about the difference between doing a HELOC versus a cash out refi.
Sure. Yeah, they have a lot of upsides and downsides to both. The main trade-off is usually cost versus flexibility. So that's definitely a good conversation to dive into later on.
Yeah, that's great. Did you want to add anything else? I know you also had a case study, because I feel like another thing that's been really important as I've talked to a lot of buyers and sellers really is trying to price your listings correctly. Because I'll share another example afterwards in terms of what happens when you don't price a listing correctly versus when it's priced correctly. But I think you had a case study in mind as well.
Actually, I've got a couple other things we wanted to touch on first. I kind of alluded to earlier that we've got a critical undersupply of new homes.
That's right.
This data sort of backs it up. So top left-hand corner, we've got the builders confidence index. We're seeing it's been declining, and I'm sure a lot of people have been seeing tons of new homes going up near them. But what's been happening recently are people who had not locked in on extended rate lock programs are canceling those new build contracts when their payment goes up $200, $300, $400, $500 a month before they're even able to move into that home. They cancel that contract. The builders got more supply sitting there on the lot, and they now have to sell that in a much more expedited cycle to make sure that it's not sitting there when they do actually complete the property.
Yeah, that's good to know. I think I'm actually going to a new construction after this, but I guess the other thing that I'm seeing is that because of the acquisition cost is so high, a lot of builders are really building for that higher end luxury market. There's a single family I'm going to be looking at. It starts at $1.2 million. That's going to be close to George Mason University here in Fairfax.
I think a lot of what the builders would say is that they need those high prices to be able to provide the safety standards that the counties require, and a lot of other codes that they're competing against. And I think that's a lot of their main gripe right now, that they could provide more affordable housing if we had reform at the local legislative level. One of the main takeaways that I have from this slide is that we've still got a critical undersupply of homes between what is permitted and under construction right now and the household formation rate. We're looking at about 130,000 homes across the U.S. that cannot find a home to go into because they don't exist yet. And so we do need more building to help catch us up so we can get a supply and demand balance back.
Yeah, I think it makes it very difficult. On the one hand, I think if you're an existing homeowner, it definitely helps out in terms of home appreciation, but it might be detrimental in terms of when you're trying to upgrade from either a townhouse to a single family, for example, because of that lack of single family in this area. But and again, maybe we'll have to talk again. I've been in touch with some people in the YIMBY movement as well, and maybe I'll have someone come on the show. They can talk about that, because I think it'll help out if there's rezoning for existing land to have more dense housing, or there's talks about changing some legislation to trade off the amount of parking that's required, but using that space to create more housing as well.
We've actually had some exciting news on the parking aspect. Fairfax County just recently reduced the required number of spots per home. So we are moving in the right direction there.
Yeah, that's good to know. I think what it means is that as you're moving to Northern Virginia, what you'll see is that there's a lot of areas like Old Town Fairfax that's more pedestrian friendly, more bike friendly. And I think that also, they're balancing that out as they're reducing the amount of parking that's available.
Absolutely. I think we're ready to move on to the next slide. And before we move on to that case study you were talking about, I thought it'd be helpful to help people understand some rough numbers they can do in their head to understand how monthly payment changes when you see HOAs go up, when you see price changes in a home. And so these are some of the rules of thumb that I use when talking with customers to really hammer that home. So the first one, every 1/8% that an interest rate shifts up or down is about a $50 a month change in your mortgage. The next one, a $10,000 price increase on a home is about a $50 a month change. And then lastly, every $50 of condo fees we go up or down is about a $10,000 change in the maximum amount you'll be pre-approved for. So I really like to work in $50 increments or 10,000 increments because I think it's easy for people to visualize when they're comparing listings once you've run that report for them.
Yeah, I think this is really useful, especially if you're looking at for a lot of home buyers in terms of the difference between buying a condo, many times with very high condo fees, $400-500 plus per month, versus something like a townhouse that might be higher in price, but with less or lower HOA fees.
That's right. Yeah, that $500 condo fee is a $100,000 difference in your maximum pre-approval amount versus something that has no HOA fee. So it certainly makes a huge difference. And those homes would have the exact same monthly payment.
Yeah, that's a great perspective. And I love the kind of rule of thumb for the change in the mortgage rate as well in terms of the impact in your monthly payment, because a lot of home buyers, they are shopping by kind of monthly payments, and it's a good way for them to gauge in terms of, without having to talk to you again, they can at least have a rough number in their head in terms of how much they can afford from a monthly payment perspective.
Absolutely. And that brings us really nicely into what we're seeing in the market on how buyers shop and how sellers are thinking about what price they should get for their home. And so we've talked about this many times recently on a couple of your listings, discussing with sellers that what they saw the home next door sell for 6 months ago is not a great way to base their purchase price without factoring in a lot of other things. And so we have seen that huge increase in interest rates over this year. So if you're looking at a recent comp that's 6 months old, the interest rate may have been wildly different. And I think this is a really good time for us to look at that example we were talking about. You want to walk us through that one?
Yeah, sure. I guess before I go through that, I was going to tell you, Joe, I think it's really important because I've been talking to sellers, and we always have this conversation because I think in today's age, a lot of buyers and sellers, they have a lot of information at their fingertips.
Right.
So they're able to pull up a lot of the comps that we're able to see. But I think, since we're talking to buyers and sellers and people in the industry day in and day out, I think we have a better sense and pulse on the markets. And I think, maybe having an overlay of what the mortgage rates were like when things were sold is very important, because what they're hearing is a lot of narratives from other neighbors or others, investors or homeowners that they knew that sold earlier and what prices that they got or how many offers that they got. Yeah. So here, I think Joe and I, we were talking about a scenario that was earlier this spring, and I think you had a conversation in terms of what the list price should be. And this is probably kind of an interesting time because you can see here in the comps at 5212 7th Street South in Arlington, it was listed at the end of March for $899,500, and it went under contract pretty quickly in the spring market, and it went over about $20,000 there.
That's right.
So that was pretty typical of what we were experiencing even in the spring market of this year. But I think as mortgage rates has increased since the spring in that kind of May timeframe, things definitely shifted in the market for sellers. And I think a great example here is in the subject property here at 5508 South Street South in Arlington, which is close by.
Right, just down the street.
That's right, just down the street. And it was listed, if you looked at it from the comps, it was listed very close to the comps. And it was actually priced a little bit under as well because this went over the list price.
Right, and I think what the agent was trying to do was capture some of that demand from sellers and cause a bidding war like what they saw in this comparable sale by going under what they knew the most recent sale had seen.
Right, and I think this is a critical kind of point here. I think these are difficult conversations to have with sellers, but as you can see in the case study, I think if it was priced right initially, the owner might have actually had more in terms of net proceeds versus having the listing stay on the market and doing a price cut and then potentially another price cut
Sure.
in order to finally sell it, because they're really working against mortgage rates as after the spring market into the summer,
Right.
mortgage rates kept inching upward through the summer.
Absolutely. So the time period between under contract and list for the second property, interest rates went from an average of 4.625 up to 5.25. That's a huge difference. So $250 a month is what the buyer sees there. They don't care what that last property sold for. They care what their monthly payment is. And so in order to make those properties equivalent for a buyer, that monthly payment needs to be exactly the same.
Right. So that was almost like a $50,000 reduction.
That's right.
In the list price.
That's right. And so we should have seen, instead of at 900, probably something more like 870 for that list price to equate for the difference in monthly payment.
Yeah, and I think this is an interesting point here, because in this listing, the seller ended up dropping the price only by $25,000 in June, in the middle of June, and it didn't actually go under contract, or it wasn't sold until early July.
That's right.
For $840. So I think this is a good kind of lesson learned in terms of, personally for me, as I talk to sellers, I feel like if they're going to make a price cut, they should make a significant price cut. So whenever buyers are searching, they're finding it at a lower tier,
Absolutely.
meaning from a $900,000 to an $850,000, for example, versus the $875. It probably makes less of a difference in terms of the monthly payment.
Right. And in this example, to further hammer it home, by the time they dropped the price the first time, interest rates had gone up another 0.5%, which means that the drop that they did that took them right around where they should have been to begin with, they needed to actually drop it even further. And I think that it's even further reinforced by the fact that this property did end up selling for less than that first price drop.
Right.
And the monthly payments on these homes come out to roughly equivalent now at this new $840,000 sales price.
Yeah, that's a good point, because you're really fighting against the mortgage rates. So whatever smaller price drop that you're making, like I was saying, it's in essence negated by the higher mortgage rate.
That's right.
So I think the other thing that I always tell sellers too is that, if you want top dollars, then you have to have the property in top condition.
Yeah.
So I think that's really important. Otherwise, you have to price it right, because we're going to do everything we can to market the property properly and try to get as much buyer traffic into the property, especially within the first 2 weeks. Because usually I think if it's priced right, from my experience, you'll know within the first 2 weeks in terms of buyer activities and the number of offers you get if it's priced right. Regardless of, kind of the opinion, my opinion versus the seller's opinion, I think the market has a way of telling us if something is priced right. But I think personally it's better to have that tough decision or tough conversation early on and price it right on the get-go, versus coming back and talking to the seller maybe 30 days from the list date to talk about a price drop.
That's right. And I think, the takeaway from all this is it's really important to have a very strong team behind you when you're looking to buy or sell a home. And I think that any realtor that's taking the extra time to bring in mortgage experts and understand how that's going to affect all the aspects of what they do, they're going to have a leg up on driving the best value for their clients.
Yeah, no, it's a great point. And I feel really fortunate, Joe, that you've been able to kind of help out and looking at a lot of listings and deals. And I think from my perspective, having that network of loan officers, title companies, inspectors, contractors, those are really a part of our extended team to make sure that we really service our clients.
Absolutely. That's all I have for you for the market data this week. I think that we're going to see some really exciting things happening moving into this fall. Next Fed meeting isn't until September. We have another inflation reading before then. This most recent month, inflation actually beat expectations, was on the lower side. And so we saw mortgage rates drop almost 0.5% after that reading. And I think that next reading in early September is going to be a really good bellwether for what we're going to see inflation-wise heading into Q4 this year. But also, it's what the Federal Reserve Open Market Committee is going to be looking at when they're thinking about that next rate hike, whether we'll see another 75 basis points or maybe something a little bit lower. As they indicated in their last meeting notes, they are starting to consider slowing that pace of rising rates.
Yeah, that's good to know. And I think the other thing I wanted to point out, though, is that there's not a direct correlation. So when you hear in the business news that the Federal Reserve Chairman Powell has raised the discount rate, let's say by 75 basis point or slowed it down by 50 basis point, I just wanted to make sure that you all understand that there's not a direct correlation just because he raises it by 75 basis point, that the mortgage rates are going to go up by 75 basis point. I think there's probably a lot of factors in terms of in the bond market that kind of dictates what happens to a 10-year bond yield. That really is, I think, a better indicator for me of what's happening with mortgage rates.
Absolutely. In the long term, we'll see that the federal funds discount rate tracks well with mortgage-backed securities. But in the short term, there is certainly a very wide range of reactions. And I think during this current cycle, that is really being driven by inflation concerns. It's really hard to lend out a fixed rate for 30 years when you're not sure if that's going to be monopoly money at the end.
Yeah, well, it's good to know. And I think, for those that are listening, if you have questions too, I think, a lot of people are trying to figure out, should I go with a traditional 30-year conforming loan, or should I go with an ARM, an adjustable rate mortgage that will adjust after a certain number of years, 5 years, 7 years, or even 10 years in terms of what makes sense for them. I'm curious, Joe, do you see a big difference in terms of rates when you look at kind of more conventional 30 years versus an ARM of different terms?
Right now, we're not seeing a huge difference. Something less than a full percentage point difference between a 30-year fixed rate and a 7-1 or a 10-1 ARM. And for my money, if I'm going to take that kind of risk and not know maybe where the property needs to reappraise in a couple of years before that adjustable rate kicks in, or what that rate might be in the future, I'd like the risk-return ratio to be a little bit better than a 1% difference.
Right. Yeah, and I think the other thing that I've been talking to owners and sellers about too, or even buyers that are buying that are feeling a little reluctant about buying at a high mortgage rate. This is my personal opinion. I'm reading the tea leaves just like everyone else. But I think for a lot of people that are buying at a higher mortgage rate, there's going to be opportunities to refinance at a lower mortgage rate in the future, and that's something that they can consider. And the great thing is that if you're buying in maybe at a higher mortgage rate, but you're possibly buying at a lower price.
That's right. We do have to be really careful when advising people that they can always refinance later. There are certainly a lot of conditions that have to be met in order to make sure that it is, one, economically viable, but two, that you qualify for that loan. I think the best way to approach that is to have a really good team behind you who understands where the market is moving, where it will likely be a couple years from now, and who can explain the major developments happening within the community that would lead to a very large shift in maybe home values or interest rates in the future.
Yeah, that's good to know. I mean, it sounds like in terms of home value appreciation and kind of how much you put down makes a difference in terms of if you can refinance an existing mortgage. I think we're very fortunate in Northern Virginia that home values have steadily increased, I think, due to kind of the lack of supply that we talked about earlier. And also, I think in some ways, we're sheltered by the general economy, even though we're technically, I think, in a recession with 2 quarters of negative GDP, that with the government and with the military, that things are still operating kind of as they normally do. Especially, for example, I went to an event yesterday, a military event focused on veterans and those that are PCSing, is that the military, they're going to keep moving their personnel from one base to another, regardless if we're in a recession or not.
That's right. And we are starting to see employers in the DC area bringing people back into the office. Some of the major employers like Capital One here has their return to work date in early September. So you will start to see a little bit more influx into the region from outside, people who were able to work virtually when they were hired on 2 years ago and now actually need to come into the office once in a while.
Yeah, that's a great point. I think Amazon's doing something similar. And for those of you that don't know, Amazon has based their second headquarter at National Landing in Arlington, Virginia. And there's also a big Virginia Tech Innovation Campus there as well. So I think this was great in terms of providing some of our listeners with some rule of thumbs and a case study that we looked at. Thanks so much, Joe, for giving us a state of the market. Look forward to having you back on again to talk about how things might have changed starting this fall.
Absolutely. I'd be glad to come back. Thanks, Rain.
Okay, great. Thank you very much.